Warren Buffett says, "The Intelligent Investor is the best book on investing ever written." He also said that reading it at 19 changed his life. And honestly, when I read it, it changed how I see money forever too, because this book doesn't teach you how to predict the market or sell you some secret formula to get rich overnight. What it really teaches is how to think about money, investing, and risk in a way that keeps you safe and helps you actually build wealth long term. Here are the 5 biggest takeaways that will save you from a lot of pain, help you avoid dumb mistakes, and finally show you what it really means to invest intelligently. Takeaway number 1. Mr. Market. Imagine you own a small local coffee shop. Every morning, your strange neighbor, Mr. Market, runs in with a new offer to buy your shop. One day he says, "I'll give you $1 million. The next day, coffee is dead. $50,000, take it or leave it. Then again, $700,000 coffee is cool again. Would you take him seriously? Of course not. But that's exactly how people treat the stock market. Benjamin Graham's point: the market is there to serve you, not instruct you. Its mood swings are emotional, not rational. Your job isn't to predict where prices go tomorrow, but to know the value of what you own and use those swings to your advantage. Takeaway number 2. Stop speculating. Investing is not speculating. Investing is like buying a house you plan to live in for decades. You check the foundation, the plumbing, the neighborhood. Speculating is buying just because someone says prices will skyrocket next week without knowing what it's worth. Graham's golden rule: treat a stock like part ownership of a real business. If you wouldn't want to own the whole business, why buy a tiny piece of it? Investing means doing your homework, protecting your money, and aiming for a reasonable return. Speculation is gambling, and it's why most people lose. Takeaway number 3. Margin of safety. No matter how smart you are, things go wrong. Recessions, mistakes, market panics. That's why you never pay full price. If a stock is worth $50, you wait for $30. That discount is your margin of safety or cushion when life throws surprises. During 2008, many strong companies were sold off cheaply, not because they were bad, but because investors panicked. Those who understood margin of safety bought value at a discount and came out stronger. A great business at the wrong price is still a bad deal. Patience is power. Takeaway number 4. Pick a side. You're either a defensive investor or an enterprising investor. Defensive investors buy index funds, diversify dollar cost average, rebalance once in a while, and let compounding do the work. Enterprising investors dig deep into businesses, study financials, and hunt for undervalued opportunities. Both are valid, but know which one you are. The worst mistake is trying to play in the middle, chasing trends without discipline. Takeaway number 5. Emotional discipline. Your emotions, not your IQ, decide your investing success. When markets crash, panic makes people sell. When stocks rise fast, greed makes people chase. History proves this over and over. Graham's lesson: control yourself, not the market. Have a system, dollar cost averaging, rebalancing, sticking to your plan. That way, you don't rely on emotions when turbulence hits. Final thoughts: think of these lessons like puzzle pieces that work together. Treat stocks like owning real businesses. Demand a margin of safety before buying. Ignore Mr. Market's mood swings. Decide if you're defensive or enterprising, and stick to it. And above all, master your emotions. Follow these principles, and you'll avoid costly mistakes while building wealth steadily over time.